Today's episode is sponsored by Innovator ETFs, brought to you by SIBO, the exchange for the world stage. Michael and I have had Innovator ETFs CEO Bruce Bond on the show a number of times to talk about their different strategies over the years and how they've changed and evolved, and they're definitely a leader in the defined outcome space. They are coming out with a new strategy, July 1st, with the first dual direction buffer ETFs. These ETFs allow investors to make money in both positive and negative markets. So they're offering a 10% inverse and a 15% inverse version. For example, the 10%, if the market is down 10%, you would be up 10%, not just flat. So it's a different kind of hedge, right? It's 1-to-1 to the upside, up to the cap. So basically making money when others are losing it. So it's a total inverse of the market. It's a strategy that's racked up billions in the structured product wrapper, but will now be available in an ETF. Kind of crazy this hasn't been done before. To learn more, register for an exciting webinar, link in the comments. Welcome to Animal Spirits with Michael and Ben. Michael, I have a take to get off my chest for you today. Someone asked me last week, what are you thinking about? What's going on? What's percolating in your brain about the markets? And my thought is this decade is about market amnesia. Okay? I said before that the market can really only focus on one thing at a time. I think if you just add up all the stuff that we've been through from the pandemic and all the stuff that went on with that, the meme stock craze, the 9% inflation, the rates going from 0% to 5%, remember the little Silicon Valley Bank dust up that lasted for like a weekend? Pretty sure I wrote a 1907 post about that. It lasted at least 5 days. You had the carry trade blow up was a thing. Liberation Day, obviously. Now the U.S. bombing Iran. It just kind of feels like investors get jittery when this stuff happens. Maybe the market nosedives for a little bit, and then we kind of forget about it and move on. And I started talking about this last week about how the whole LOL nothing matters kind of thing. But Mike Bird from The Economist wrote a piece on this, and he said, and this is the headline, and a bunch of people sent us this because we had discussed this last week. Investors ignore world-changing news, rightly, the nothing ever happens market. And I almost think that this sort of market amnesia is a good thing. If you're a successful long-term investor, you almost need this. And I know a lot of people think, well, eventually this ends badly. But this was interesting from the Economist piece. So there's a paper going back to 1988. These researchers from MIT, apparently Larry Summers too was part of this. They wanted to figure out what actually moves stock prices. And then they look at 5 decades worth of world-changing events. So they looked at Pearl Harbor and the Cuban Missile Crisis and the Chernobyl nuclear meltdown. And they figured that the volatility of returns on the day of these news events, these geopolitical big things that happen, was less than 3 times as large as on an ordinary day. Several of the biggest one-day falls identified by the authors occurred on days without an obvious news-related spark. And I think a lot of this stuff is probably counterintuitive. And I think maybe investors have finally learned their lesson on this stuff. And this is another feather in the cap of my idea that investors are becoming better behaved, because it's like, listen, we've been fooled a million times on these headlines. This bad thing's going to happen. That bad thing's going to happen. I'm just going to ignore it all. And I think that actually this is another step in the right direction for investors. Thoughts?
It's a good take, and I agree. But I think we have to also discuss the why. Why are investors ignoring all of this? It's because it doesn't impact NVIDIA. Right? Like earnings for the stock market are not going to be impacted by a lot of these geopolitical flare-ups. If we were in a different market environment with slow or no growth, if energy was 15% of the index, if, it would be different. But right now, what's driving the train are the expectations of long-term earnings growth. Now, I don't think that investors like day-to-day are thinking about that, but ultimately, that's where this is going.
Yeah, and Bird in his piece talked about how, I can't remember what the time frame was, 10 years or 15 years, the earnings are up like 250%. And like you're right, that is the thing that matters, right? Higher gas prices is going to impact Apple and NVIDIA.
So how about this? If we were in a stagflationary environment, each one of these cuts would take us down. Because it would just be like, oh my God, just another thing. Like, how much could we possibly take? But we're in an opposite environment in which none of this seems to matter.
It is interesting though that just because I know stuff happened in the 1990s and 1980s, but it doesn't feel like it was quite as earth-shattering as what we've lived through this decade. Maybe that's recency bias on my part. But it is just weird to see all these things happening and then the market's still not caring.
Well, here's the other thing. Right now, the supply chain is built on AWS or whoever's cloud provider it is. Companies are so much less reliant on, like, quote, real world stuff. We have the ability to dial up and down productivity so much quicker than we did in the past. So yeah, it's a different world.
Yeah. And I've written before on the whole stock market versus war thing. I'll put a link in the show notes. But just, I looked at all these events, World War I and World War II and the Cuban Missile Crisis and Vietnam and the Korean War and all these.
Are those comparisons relevant for today in any way, shape, or form?
I think that they're relevant in the fact that it's the relationship between the market and those events is typically counterintuitive. Like war in the past, war has been bullish.
Right.
Which is I think I always say the stock market is heartless, but if you look back at almost all those periods, the stock market did great. You know the stat that World War I, the greatest year for the Dow ever, was 1915.
Oh, 1915. Oh, because the market was.
That was after the market closed, but that was during World War I that had happened. It was up like 80-some%.
Yeah.
And
Israel's stock market hit an all-time high last week.
Yeah. So again, if you think these headlines are like somehow bad for the market, then, and Josh has got this thing on like the Strait of Hormuz or whatever. I don't know how to say it because I've only read it before. But when you start seeing people talk about that, that's a buy signal. I just think investors have become accustomed to these things. And sure, there's going to be a rug pull at some point where one of these situations is really going to matter. I just don't know what it's going to be, and I don't think anyone else does ahead of time either. So I think just ignoring this stuff and continuing to invest, I think the thing that's hard to recognize for a lot of investors is that the reason you make a change in your portfolio should usually be dictated by something that's happening in your life, not the markets.
Mm.
And that's very hard to realize and recognize, right?
Yeah.
It's like a change to your financial plan, or you're making more money, or you get an inheritance, or you're making less money. Something like that. That should have a greater impact on your portfolio changes than what's going on in the headlines.
Ben, it seemed like this was the week where a lot of the media started to publish on the biggest companies across America are cutting their workforces. It isn't just Amazon. There's a growing belief that having too many employees will slow a company down, and that anyone still on the payroll could be working harder. That was the headline from the Wall Street Journal. So they showed that U.S. public companies have reduced their white-collar workforce by 3.5% over the past 3 years. Over the past decade, 1 in 5 companies in the S&P 500 have shrunk their employee count. And they show this great chart, number of white-collar employees at U.S. public companies, the change since the end of 2021. And they break it down by staff, executives, and managers. And everything is negative, but particularly executives and managers, which makes sense. These middle managers that are not revenue generating, whose job it is to oversee a lot of these people, just world of pain.
Can I make a claim on this, a take that is, there's a short-term take and a long-term take. Over the long term, I think you do have to be concerned about the labor market and what AI could do. Over the short term, I think a lot of these stories are huge overreactions because this is from May 2022 to May 2025. 2022 was perhaps the hottest job market we will ever see in our lifetime. And so places were overstaffed. Remember how many job openings there were compared with, so the Wall Street Journal also had this piece, and you can go against me on this take if you want, but they had this piece about recent college grads, and there's saying young grads are facing an employment crisis. Crisis in the headline, okay? And they say the overall national unemployment rate is around 4%, but for college grads looking for work, it is much higher, 6.6% over the past 12 months ending in May. That does sound bad. They put a chart in here that shows ages 20 to 24, the unemployment rate for a bachelor's degree is rising. But if you also look, they have one that shows high school degree, no college, and it's obviously much higher. So it's not like you're still getting a better deal there. But look at this unemployment rate, age 20 to 24. I pulled this from Y charts. Look at this going back historically. It's moving up slightly. It's probably at or below average going back to the 1950s. This has been way, way higher. It was higher in the 80s. It was higher in the 90s than it is today. So I think we're throwing around this crisis term way too loosely just because we're comparing something to 3 years ago. I think people are overreacting.
Yeah, I will take the other side of that. I don't agree. I think that
Look at the stat. Look at this chart I just put in here. It's if you look back historically, I think we just talk about this stuff more than we did in the past.
is this chart gonna go back down in the next year or 2 or 3 years? No. Do you think it is? I don't.
Probably not, but look at how many times in the history that it's gone up. Still got a lot of room to run to get anywhere near what things were like in the 80s or 90s.
Recent I'm sorry.
Recency bias.
Revenue per employee is back in favor as a metric investors and executives track carefully. Yeah, no, I will take the other side of this. I think that this is not going to reverse. And I think that a lot of people are in for a world of pain. No, I don't know that it's going to necessarily like tip the economy into a recession or anything like that. I don't know. But I think that the white collar manager that was very comfortable should be very uncomfortable.
My sense is I think these things take time to play out. So another one from Wall Street Journal was Americans are side hustling like we're in a recession. So they said the two-job trend these days is the necessity, not pursuing a passion.
I'll take the other side of this headline.
Yeah.
I think that the idea of a side hustle, and let's be honest, like, I know I said let's be honest. What percentage of side hustles are done over the internet?
Right. I think it's just easier to do a side hustle these days.
How could you have done a side hustle in the 90s? Like, what were you going to do? Like, mow lawns on the side?
And I put multiple job holders as a percentage of employed in here. And again, this is something that was much higher in the 90s, and it's still like 5 or 6% of total employees. So it's not. So here's one that kind of is to your point. This is from Andy Jassy, the CEO of Amazon. He wrote a piece about thoughts on generative AI.
By the way, there was a lot of throat clearing in there. It was basically like a page and a half of enhancements of generative AI and how they're using them all over. And then it's like, yeah, we're going to need less people.
Yeah, he said, he talked a lot about what it's going to do, but he said, as they roll out more generative AI and agents, it's going to change the way their work is done. We expect this will reduce our total corporate workforce as we get efficiency gains from using AI extensively across the company. And I asked you, I think on Slack, how do we separate the actual AI productivity gains from the fact that tech companies probably overhired and need to cut workforce? It's a balancing act to think through what the actual reason is, right?
Well, it's also I think it's also getting ahead of we're spending a lot of money. Mm-hmm. Let's try and cut some employees. It's kind of like Doge though. It's like a drop in the bucket. How many people are you really going to let go to offset the spending?
So I also think that just the labor market dynamics in the years ahead, if you combine AI with 10,000 baby boomers retiring every single day, I think we're going to get some weirdness in the labor market data. I think it's going to be very bizarre for the next 10, 15, 20 years.
Yeah. All right. This is surprising to me. Bob Elliott tweeted, "It seems the hard and soft data have converged toward each other." And it happened with soft data, a lot of the survey stuff catching up. I would have considered this to be, let's say like plus 280 if I was a betting man 4 months ago.
So sentiment turned around. Well, it looks like the hard data did fall. I don't know what this is. I don't know what this is measuring here, but you're right. The sentiment there to me looks like the stock market.
I would have said like the odds of them converging because hard data is falling fast. And now, to your point, hard data did fall, but I would have said minus 115. So, yeah, surprising.
So V-shaped rallies are still here in everything. Everything's a V.
All right, this is something. The Financial Times put out a report that said X, as in Twitter, chief executive.
You're a narc if you call it X. Got to call it Twitter. Sorry.
I'm just reading.
I know. The worst is when people say Twitter, I mean X, like it's still Twitter. Yeah. Sorry.
Linda Yaccarino has said that users will soon be able to make investments or trades on the social media platform, as she outlined a push into financial services and owner Elon Musk's quest to build an everything app.
No one's doing this. You already can do it on Robinhood or where, like, this isn't going to work.
Yeah, I would agree with that. This is going to be a flop.
Yeah, no one's going to do that. No way. Sorry. Who's ever been able to make the everything app? It's not a thing. Ryan on The Office. Woof Woof or whatever it was called, right?
What do you mean, I don't know what you're talking about.
Okay. Ryan on The Office had this idea where you put one social media post out and it goes immediately to Facebook, Twitter, LinkedIn, and then it would send a fax and it would do everything for you. All right. You still got to catch up on The Office, I guess. Okay. Torsten Slok chart of the week. I don't know when this is through, but he's saying a record high foreign ownership of the US stock market. So I don't know if this is through April yet or not, but it is kind of crazy that we've gone from essentially 5 or 6% foreign ownership in the stock market in the mid-90s to nearly 20% now, and how important globalization is to our financial markets. And I think this is like the rest of the world catching up with us too, and realizing, I've seen all this stuff. I think Vanguard had a good study a number of years ago showing that home country bias was even worse in foreign countries.
Probably not anymore.
Which doesn't make much sense because those countries' stock markets are so concentrated and they're such a small piece of the global pie. Like foreigners should have a much higher ownership share of U.S. equity. Kind of like how we talked last week, how people have a higher allocation of stocks than cash and fixed income they did in the past. This is the kind of thing that is a trend that shouldn't really reverse and probably should continue to go higher.
How high can it go though?
If we're 65 or 70% of the global stock market, it should be higher.
Why? Why? Foreign owners own almost 20% of the market. How high should it go? That's a lot, no?
Well, I don't know. I'm just saying, if we're 2/3 of the market, there should be a really high ownership of U.S. stocks by foreigners.
Yeah.
Pension funds and sovereign wealth funds and individuals and family offices. Think about it.
All right. We spent a lot of time talking about concentration in the S&P 500. Schroders has a chart that shows market concentration is a global phenomenon. This is
what I was just talking about.
Top 10 stocks in UK are 50%. Wow. So the top 5 here are 26%. The top 5 there are 35%. 25% in Japan, 23% in EM, and 70% in the ACWI. So it's not just us.
I've looked at this before. Oh, the rest of the world is way worse because their stock markets are smaller. So I think if you look at like Korea, Samsung makes up like 25% of their index or something like that.
I think we spoke like years and years ago about Greece. I think it's like hilariously skewed.
Yes, that's the thing. In other countries, it's even worse. That's why. So Samsung is 20%. So there's two names that make up 30% of the South Korean stock market ETF. And so, the concentration over there is way, way worse.
All right, here's another good one from Bank of America Global Research. Once a diverse index, the S&P 500 is now 50% growth. So they broke it down by pure value, pure growth, and blend. And pure value has gone from 25% in 2005 down to 15% in 2015, down to 9% in 2025. While pure growth went from 35% up to 50%.
Remember when Apple was a value stock for like a year?
Yeah, it really was.
Traded for like 12 times. Is that when Buffett was buying, basically?
That's when people were talking about back out the cash. And I think a lot of nitwits, probably myself included, were like, LOL, back out the cash. Well, back out the cash. Great investment.
Yeah, it sort of worked. This is, I guess, another one that makes a lot of sense. Because that's also 2005 period. Value had a really good run for about 5 years following the dot-com bubble.
Ben, let's talk about cars. Also from the Journal. Light vehicle sales have fallen by about 1.7 million a year since 2016.
This was a really good piece, by the way.
It was. It really was. I agree. Reflecting the number of younger consumers declining the pleasures of ownership. Millions more remain trapped in toxic relationships with abusive elders. They're talking about cars. The average age of passenger cars on the road is currently 14 and a half years. A friend of mine...
It's kind of crazy.
Has a Cherokee EV. And the thing just died. Like it
doesn't sound like your Jeep EVs are doing very well because you say yours isn't great either.
No, it just died. It won't turn on. It's like a year old. The total cost to own and operate an automobile averaged a frightening $12,296 in 2024, roughly 30% higher than a decade ago.
So that's insurance, gas, maintenance, all the stuff that goes with owning a car, right?
New cars are 50 grand almost. In 2024, the AAA calculated the average new vehicle loses. The average new vehicle loses an eye-watering $4,680 in value every year.
Big time depreciation.
Dude, it's wild. Like cars suck.
That's nuts. Every year for the first 5 years. So they're saying because some people are now priced out of new cars, which is almost 50 grand. Demand for used cars is up. That means the average used car is now over 25 grand, which is kind of insane. Obviously, these cars are lasting longer.
I wonder if some people are gonna be like, you know what? I'm just gonna start taking Ubers everywhere I go. There's no way I'm spending $13,000 on Ubers a year.
If you calculated it out.
So especially for 2-car households.
You know, I see a lot more of the electric bikes on the road. If you live in a nice climate, that would be appealing to me. You're right.
Cars have become a huge pain in the ass. They're so expensive. They're so reliant on computers. They spoke about how much plastic is in cars and how they're basically built to die, sort of like the iPhone.
The other thing that this touched on was the cost of insurance and the cost of maintenance has risen a lot because of all the sensors and such that we have in there. That it's anytime you get it fixed, it's not cheap either, and that's one of the reasons that the prices keep going up because the cameras and the sensors and all the stuff they're putting in there is more expensive as well. Unfortunately, I think a lot of people assume that having like a 2-car household now is the thing, right? But you're right; it's hard to get off of that, and maybe some people will these days. But yeah, some of the stats in here were pretty crazy. Okay, so Mark Zuckerberg is desperate. I think this is kind of his whole thing, and I mean, I guess it really kind of goes back to the Social Network movie about him. He just seems like a guy who's constantly searching for something. I don't know if it's approval or but he kind of changes up his style and he just seems like a nerd who like is constantly trying to be in the in crowd, right? And I think that's actually been a good thing for him in his career.
Because I think Mark Zuckerberg's his image today versus 5 years ago, forget about it. Or 10 years ago, even too, during the election was not great. I think his approval rating is maybe at an all-time high.
Just because he grew his hair out curly.
Yeah.
Right? Got a tan and started doing like Muay Thai or something. So Sam Altman talked on a podcast recently and he said, Meta started making giant offers to a lot of people on our team, like $100 million signing bonuses, more than that in compensation per year. And I think Altman was bragging like, hey, a lot of our people are turning them down. So you mentioned Scale AI a few weeks ago, I think, with Mary Meeker's presentation. And I think 2 days later, Facebook made a $14.3 billion investment in them. And they wanted the founder to help now. And they also made a big investment, Daniel Gross and Nat Friedman, who are on this trajectory podcast every once in a while talking AI. I don't know if you've heard any of those interviews. They brought them in to like run their AI efforts. And so it's interesting to me because this all to me sounds like they are behind. But I also wouldn't, because of, again, his like desperation, and I'm not saying this almost in a bad way. I'm saying like, I think it's worked for him, but he seems so desperate and you almost think like, God, they must be really far behind, but I wouldn't put it past him to make all these investments and then come out ahead still and be okay.
You said you don't mean desperate in a bad way. I think he's paranoid in a good way.
Yeah. Well, and that was like the Grove book, right? The Intel guy.
Yeah. Only
the paranoid survive. It seems, but obviously he's, whatever they've done, he's looking at it and going, oh my gosh, we're behind someone or something. I just do wonder with all the money being thrown around, what's the breakdown between people who are just true AI believers and this is going to be our next God or something, or this is going to, the sum total of human knowledge and is smarter than humans versus people who are just like, all right, this is signing bonuses. I'm going to get my 5-year max to play for the Grizzlies or whoever. Like, I would love to know the breakdown.
Who cares?
I don't know. I'd like to have some morality, I guess, in AI because it's going to be this life-changing technology. I just want someone behind the wheel who's going to be like, look out for like humanity and all this. I don't know.
What was the name of the AI in Mission Impossible?
See, I didn't watch the new one yet.
What?
I'll just wait till it comes out on video. I don't care.
All right. I mean, you're Mr. TC.
I am.
Not?
Yeah. I don't know. I'll get to it.
Okay.
But yeah, that's a big thing though. AI as the that's going to be because we couldn't make the Chinese the villains in movies anymore because you have to sell movies over there. And so I think the Russia thing has kind of been played out. You can't really do Nazis anymore because it's too far away from World War II. So AI is just going to be the villain in like every movie going forward.
Yeah, I've probably seen a dozen of the last 12 months.
Right. It's not that great of a story though anymore, right? Can we just have an off switch for AI if it gets too powerful? Just turn it off.
What's the
Hit the
space about
reset button.
radiologists?
Okay, this is interesting. This is why I think the labor market stuff is going to be hard to predict. So this is a story in the New York Times, and they say 9 years ago, one of the world's leading AI scientists singled out an endangered occupational species. He said at the time, Jeffrey Hinton, people should stop training radiologists now. It's just completely obvious that within 5 years, AI would outperform humans in that field. And they say today radiologists are still in high demand. And it's true, they say at Mayo, they're using AI to help identify any like medical abnormalities and predict disease. And it can also serve as a second set of eyes. Hey, I'm looking at this. What am I missing? Or what, check me. But they say that there are more radiologists than ever. And actually, AI is helping them. And they're because of the demand for healthcare, they're needing more radiologists. So it's not putting them out of business. It's just becoming helpful to them in their job. And there's actually, it's increasing the demand for radiologists.
So there's three things that are going to happen, I think, and probably a lot more than I'm not thinking of. Industries are going to get displaced entirely. The thing that
customer service.
The thing that you just mentioned, no. Actually, radiologists are going to be in higher demand, and AI is going to help it be more productive. And then the third and hopefully biggest category of the three are new jobs that we cannot possibly predict today because we don't know what technology is going to exist.
Yes,
and that would be the hope that there's going to be new demand for new jobs that we just don't know about yet.
And unfortunately, most people will pay attention to the first one and get really mad about it.
Right. So, for example, a little teaser on Talking Wealth over at The Unlock, I'm speaking on Wednesday at 11 to Dave Nottig, and you and I could talk about this, Ben, next week to rehash. I want to get your thoughts.
Yes, I have thoughts.
My kids will not use a financial advisor. A human being will not financially advise my children. More to come.
You're selling your kids short there. You're saying they're not going to have any money. Is that the problem? Yeah. Okay. You laid this out to me, and I definitely have. But I agree with you. Those three things, and the hard part is going to be the transition phase. It's really going to be interesting how the next 10 years plays out, because there's going to be a lot of people who are really, really mad.
All right.
I mean, so we had the tariff thing, and we argued about we need to make our iPhones in here again, right? There's going to be situations where AI is all customer service, and people are going to go, we need to have real people again for customer service.
Nah.
And
I'm going to be the guy saying, I remember when there was not real people, there was real shitty computers that always broke or never worked.
You think AI is also going to go, hang on just a sec, my computer's running a little slow today. That's every customer service person in history. So they can look up your whatever. But there are going to be people. The other day I did a blog post, and I like to include a picture or something there for social media, right? And I think I did a Keeping Up with the Joneses one. I pulled something from Daniel Crosby's book, since we talked to him, and I used some studies. And I did people standing in front of their toys and houses that are unhappy, right? The Joneses aren't as happy as you think they are. And some dude hit me on social media with, oh, cute, you're using AI to create pictures, making fun of it. There's going to be people who are anti-AI and totally I'm not going to use this technology. There are going to be people who are too cool for AI.
I mean, that's going to be a thing. That was you with Facebook and coffee.
But I'd never used it.
Right.
Either of them.
Okay.
Still never had a Facebook account.
This is meta. I just asked ChatGPT, how many people in the United States work in call centers doing customer service roles? How many people do you think, Ben?
1 million? 500,000?
2.8 to 3.4 million, according to ChatGPT.
Do you remember the presentation? This is a long time ago.
By the way, that's a lot of people.
There's a lot of people. We had a presentation or a conference in New York a number of years ago, back before we knew how to do actually good conferences. But we had Scott Galloway there, and he did one of those presentations where he went through 1 million slides. And remember the Amazon store where it was going to be you walk into Amazon store, you put the stuff in your cart, and you walk out, and it charges you.
Mm-hmm.
I don't know if that still exists or if it just seems like it never.
They're in the airport.
But Galloway was saying, listen, there's 2 to 3 million people who work at cash registers, and those people are going to be out of business. How come stuff like that never happened?
I think it did happen to a certain extent with the self-checkout lanes. There's there's way fewer cashiers at like the grocery stores than there used to be.
There are still people who do not know how to use self-checkout lanes. And I don't get it how at this point, like there are certain people, I feel like you should have to pass a test. Like there should be a timer, a shot clock for self-checkout lanes in the drive-thru. If you take too long at the self-checkout lane of the drive-thru, sorry, you either go inside or you go to a person to pay.
I agree. The cashier should say, nope.
Yeah, you can't hold up society. Sorry.
Yeah.
There's someone come and sweep all your stuff and move you over here. You lost your privilege for this as a human being.
All right, I don't have a ton to say on this topic other than I just don't like this. Brian Armstrong at Coinbase said, the world needs crypto now more than ever. Now, as a fellow bald, I appreciate his baldness. And I guess it's like, if a barber's going to tell you need a haircut, so what I would expect him to say. But goes on to say, debt is growing exponentially. Inflation is crippling entire nations. Economic freedom is declining. It's time to increase economic freedom globally with crypto. Actually, you know what? Maybe I will give a pass here or try and interpret what he's saying. Because he didn't say Bitcoin. If he said Bitcoin, I would have just said hard no. But stablecoins actually do increase economic freedom, I think, or can. Not an expert, but if I am somebody who lives in a country with not this more stable currency, the idea of digital dollars sounds pretty good.
I feel like people don't even make that anymore. Oh, we're going to stablecoins in a minute. How many CEO pictures do you think are them not looking at the camera, but looking away?
What's he looking at?
Yeah.
Here, look over here. Look over here.
So someone also sent us the Coinbase, and I feel like they should almost be spiking the ball instead of trying to make weird arguments, but there was a commercial in the NBA Finals. Someone sent this to me, and it was saying how like 5 years ago, it cost X number of Bitcoins to buy a house. It was like, 10 Bitcoins to buy a house.
Who uses Bitcoin to buy a house?
Now it costs 2 Bitcoins to buy a house. And it was kind of saying, it was just a weird way of...
set number go up.
Yeah. Okay, so back to stablecoins. So the Genius Act, and I love what they're doing now. Maybe this is another AI thing.
By the way, I saw somebody tweet, who was it? About, it's called Genius because Trump refers to himself as a stable genius.
Ah, okay. Is that why?
Good.
All right.
Pretty good.
So all the articles these days now have the key points, and I think that's just taken from AI. But so this Genius Act, it regulates stablecoins, and it also mandates you have to have $1 of reserves for every $1 of stablecoins, right? So this is like if you're going to be using this stuff has to be backed, and ironically enough, this stuff is just going to increase the demand for dollars, obviously, right? This is bullish for U.S. dollars, correct?
I would think so.
And T-bills probably, because treasuries, isn't most of this money just going to be invested in T-bills and treasuries then?
I don't think anybody wants a stable coin that's backed by the lira.
Right. But so this is going to just, people always say like, who's going to buy our debt? I guess it's stablecoin issuers. But so Sam Lee, who's a great follow and probably one of the most successful crypto people that no one ever talks about, because he just kind of does, he used to work at Morningstar. He runs his own financial advisor firm. He tweets about crypto once in a while, but he is probably one of the best crypto people I know who's not completely into, he's like more the human side of it.
All right, what do you say?
So he just talked about how this is like a huge, huge deal potentially. So he's saying, listen, it's profitable. So someone like Tether earns $6 billion a year in risk-free because their stuff is backed and they just put it into T-bills, right? Also, he said, big corporations now have permission to go after the market and grow. They can more easily compete with Visa and MasterCard and American Express. Retailers in particular have a strong incentive to cut credit card processing fees. Most importantly, the act grants stablecoins legitimacy, which will spur adoption by individuals. So one of the stories I saw said, like, why wouldn't Amazon and Walmart just create their own stablecoin and totally do away with the 2 to 3% processing fees? He's saying, let's see, in the long run, with more legitimate, non-speculative economic activity occurring on stablecoins or cryptocurrency networks that power them will become increasingly attractive places for commerce. We could see huge growth in decentralized financial protocols. So this is obviously like recreating the rails of the financial system. So he's kind of saying like, listen, a lot of this stuff is not imminent. It's going to take time to build out. But the fact that this stuff is a possibility now is one of the reasons that a company like Circle is going bonkers, right? And trying to bet on who the winner is going to be. Like, it's kind of like if you can rebuild the rails of the financial system and potentially, challenge credit card companies, like the possibility for this being a huge company is really there.
Weisenthal tweeted, here's Circle on every day since its IPO. Incredible run. So this is literally daily returns. Up 168, that's IPO day. Up 29, up 7, down 8, up 10, down 9, up 25, up 13, down 1, up 34, up 21. LOL.
Those look like annual returns for the S&P.
Hey, let me tell you a quick story. It's long. I'll try and make it quick. So my house that I rented out is closing hopefully soon. I have paid either 3 or 4 months of my mortgage without a tenant, which was not that much fun. She left, not abruptly, but I was like, all right. She's been there 5 years. And she's like, no, actually, I'm leaving in 30 days. So I was like, oh, well, could use a heads up. Anyhow, so just in terms of like eating away at whatever return I made, which, I got very lucky, but still 4 months of mortgage payments and a decent amount of repairs, unfortunately, to pass, inspections and all that sort of stuff. So I had a plumber come in, and there's a couple of issues, not important, but the bill was $2,800. And I said, can I see the breakdown? There was 4 different things. And one of them was $1,000 for a sink, $200 for a faucet and whatever, the rest labor. I said, that sounds really high. I'm going to phone a friend. And the rest of the things I spoke to my broker, and he said, yeah, everything else is reasonable, but that's crazy talk. So I said, all right, instead of $2,800, what if I'll give you guys cash? Can I give you $2,400? He said, okay, fine, we'll do that. I went to the bank, and on the way to the bank, I called my friend and I said, hey, can you install a sink, a faucet? He said, yeah, great. All right. So I went to the bank and I got $2,000. Now I owed them $2,400. I'm sorry, I owed them $2,500. I owed them $2,500. I asked 24, this 25. Okay, fine. The bank was closed. It was Juneteenth. And the maximum amount of cash that you could withdraw is $2,000 from Chase. Did you know that?
Did not know that.
From your debit card. Now the bank was closed. There was no tellers. I couldn't go to the window. So I called them up and I said, hey, could you please increase my limit? She said, no, you're maxed out. I said, really? The most cash that I can access on a day is $2,000. And she said, yes. But I said, but I need more cash. She said, well, I'm sorry. You can go back tomorrow. Like I can't override. You're at the max. So obviously I'm thinking about stablecoins and all this. I'm like, this is crazy town. So and then they pissed me off. I called them back and I said, listen, I'm not going to do the faucet. So whatever that is, $1,000, just knocked it off the price and I'll give you cash. He called me back and said, actually, you no longer get the cash discount. Now it's whatever, $2,000. And I'm like, oh, come on, really? Like, so now why even pay my friend $500? I might as well just have you just do the whole thing. So he's like, anyway, we're going back and forth. And he said, all right, fine. You could put $2,000 cash, $500 on the credit card, no additional fees. I said, all right, fine, just do it.
So you wanted to pay him in Bitcoin?
I went back to the house, took $2,000 out. And I said, hey, is it cool if I just leave the money in the drawer? I'm going to, I don't want to sit there and watch you do this. He said, yeah, no problem. Nice kid. He called me later that night and said, there was only $1,800 in the drawer. And I said, no, there wasn't. I took out $2,000, put it in an envelope, took the money out of the envelope and put it in the drawer. I said, I will go to the house over the weekend and hopefully it's there. And he said, okay, what would you have done in that situation if the money wasn't there?
Nowhere to verify,
Yeah, it's my word against his.
Yeah.
Anyhow, the $200 was in the drawer, which made me very happy. I was like, I don't want to call the credit card company and tell them to reject it and then get this kid in trouble.
So he just didn't see it?
Yeah, so I'm like, dude.
Oh, okay.
So he just, because it was, it was a small stack of bills. So I guess he just picked it up and there was just 2 that he didn't pick up, which is just odd. But anyhow, so the whole point of the story is buying an investment property, not that much fun, right? Paying several months of a mortgage, not that much fun. Paying to repair a window, the paint, the this, the that, going to the town to make sure not that much fun. The return on hassle, as Nick likes to say, not great, not doing this again. Even though it was a very good financial outcome, still pain in the ass. And also $2,000 at the bank, come on.
Yeah, you don't deal with this with index funds, right?
No, come on, Chase. Did you see
Wait. So, but what is this? So, is your crypto thing? Do you think crypto like makes this sort of transaction either? Because I think I heard this story once, and I'm outing one of my uncles here. But one of my favorite stories from my uncles was that I think this is in the '70s. He's riding a 10-speed bike home from a party, and he he hits a crack or something, and this is like downtown. I can't remember, Detroit or Grand Rapids or something, and he falls over in front of a cop, and a joint rolls out of his pocket. And they brought him into and this is on a Saturday. They brought him into jail to like book him for a night of jail. He had weed on him. And my mom and her sister were going to go pick him up at the jail, and they didn't have any money. No banks were open. They couldn't afford his bail. They had to wait till Monday to go to the bank to get some cash out to go pay $50 or whatever it was at the time to get him out of jail. So he had to spend the weekend in jail. This is pre-ATM. There was no ATMs back then. So my point is it could have been worse. You could have had nothing.
Now, I guess a listener or you or even me could say, well, why didn't you just Venmo them? Like, what's wrong with Venmo? Right? I don't know. But the point is, banks as they currently exist are just it's a time of a different era.
Yeah, maybe on purpose. All right. You know the I'm Not Leaving meme? I guess it's Leo from Wolf of Wall Street.
Sure.
Overrated movie.
I think so too. A good movie.
Decent movie. I watched it once. Overrated. That's boomers with their housing. Redfin says 1 in 3 baby boomers say they will never sell their house. And another 30% say that they'll sell at some point, but not within the next decade. Boomers aren't leaving it. I kind of tend to believe them because they've lived in their house for a very long time. I think the number is they said 2/3 of boomers have lived in their home for 16 plus years. And it also shows that younger people say that they're more likely to move if they can. I'd still do think that there's a cohort of millennials who are going to be in their house for a long time. I am personally, with a 3% mortgage. My oldest daughter is 11, youngest are 8. Like at least until the kids are done with high school or college, probably we're in this house.
I really want to be on the water, given that I'm a nautical man, but I'm not leaving.
Right? It would be hard. I mean, things do happen, but I can't see it. And plus, listen, we're finally taking some of that home equity line of credit. I'll talk about this more in the weeks ahead, I guess. And we're doing some
Are you doubling
renovation.
The size of your mudroom?
I wish. Mudroom's not being touched. But we're doing like new flooring and, if we're doing new flooring, we got to do a new paint job. And, hey, if we're doing a paint job, we have to change the banisters. And so I'm like, one decision leads to 3 or 4 in housing. And this is another point of the return on housing. But sometimes you make these decisions about how you want your house done. It's like almost an experiential thing. Are we going to get a 1-to-1 return on what we're doing? Absolutely not. And it's very expensive, way more expensive than I thought. We're putting like hardwood floors throughout our whole house. It's not going to be cheap. But we're going to live there for a long time, so I don't mind making this investment.
Yeah, if you amortize that cost, it's nothing. All right.
Wait. One more thing about the negotiating, though. Like you said, paying in cash. Like I think that's a thing you should do for any type of renovation. Like, hey, if I pay cash, will you make it cheaper? And I was going to do that tactic, but they offered me 0% financing for a year. Done. Don't ask me again. Of course I'm going to do that. I'm going to get it. Let them carry the cost for a year for a very high cost thing. Sure.
Was that through
Put
Klarna?
it on my tab. No, not buy now, pay later.
All right.
I'd be fine with that though if it was.
Let's run through some stuff in private markets. We're getting long, so we can do this quick. There was an article over the weekend or last week. Fidelity rolls out custom models with alts via Investnet partnership. We are in the early innings of this mega trend. It feels like I think financial advisors feel like it's a bubble because there is just so much activity from these alternative asset managers, like just hounding us relentlessly. So from that respect, you could say there is way too much supply, which I'm calling the relentless ask. There's way too much supply of these investments and maybe not enough demand to soak it up. Now, that may be true, but they're coming. And if you want to learn more, another plug for Talking Wealth on the Unlock for advisors. I spoke with Phil Huber, and it was great because there's a lot of negative press, some of it very fair, some of it kind of nonsensical that we got into. But there was...
and Phil comes from both sides of the aisle, so he can speak. He was an RA. But the thing is, this thing getting like the model portfolios and the target date funds, like that is the entrance. That's the foot in the door. When you have it, when it's in the models, and a lot of people use those, and a lot of advisors rely on those, like that's when it's a really big push.
So there is a JP Morgan has this guide to alternatives, like they've guide to the markets, guide to retirement, guide to alternatives. I want to run through some quick charts. So they show public and private manager dispersion. And when you look at global large cap equities, the dispersion over a 10-year period, it's nothing. On the high end, it's 8.9%. On the low end, it's 7.2%.
Wait, and this is like top and bottom quartile or decile? Or
I don't know what it says exactly, but like the point is, if you throw a dart at large cap managers, even if you hit the worst of the worst, whatever, okay. So the market did 9, you did 7.2. You know what I mean? Like if you selected the worst. If you're throwing darts at private equity, you could be in for a wall of pain. And let's be honest, most people are throwing darts.
This is a great chart. David Swenson talked about this a lot. Like if you're not in the top quartile, top decile for these private assets, it's not worth it.
So, all right. So here's what it is. It's 75th percentile. And then on the bottom is 25th percentile.
You're right. So it's top and bottom quartiles.
So 21% on the high end for private equity, 1.5% of the low end, and no liquidity. How do you like that? That's
and the
fun.
bottom quartile for venture and real estate are negative returns.
Horrible. So yeah, you better be careful and you better be right.
But this is why private credit is the thing. Private credit of all the privates has the lowest dispersion. So this is why I think most advisors will be most comfortable using private credit. And it's also the easiest thing to sell.
I agree with you.
Yield. Oh, we're giving you 10% yield. What else do you need to know? Nothing.
Yep.
Sign on the dotted line.
Investor asset allocation. So institutional investors, 22% to alternatives, 78% to traditional assets. Very high net worth and family offices, so 30 million plus, have 19% in alts. High net worth investors, 5 million to 30 million, 2%. So they are pushing, and I don't know how much winning they're going to do, but they're going to win, in my estimation.
Right. You want to bet against those places? That chart you had that showed BlackRock versus Blackstone and the assets versus the market cap.
It's unbelievable. So BlackRock has 10 times the amount of assets as Blackstone, yet Blackstone's market cap is 10 to 15% larger.
Right. It would be like Vanguard versus any active manager. Like Vanguard's market cap, if they were a publicly traded company, would be much smaller than a lot of the active, even though they have trillions of dollars.
That's exactly right. I spoke with Phil about the story about Yale. Well, listen, if the Pioneer are dumping their private investments, and like they're not dumping their private investments. There are other parts of the story, but the chart that I want to point to is secondary market volume has gone from $25 billion in 2012 up to $162 billion in 2024. There is
what is Phil? So a lot of this is rebalancing too.
There's just so much more liquidity.
Yeah, it's easier to trade now. But again, I think a lot of that is rebalancing.
Perhaps, yeah. There was a story again about Zweig wrote about this, about marking up to NAV when you buy something in the secondary market. And Phil and I spoke about this. If you're buying something for 40 cents and you're marking it up to $1 and you're taking carry, that's horseshit. But a lot of these buyouts in the secondary market are at a 5 to 6% discount to NAV. So, okay, that's the price. That's the cost of liquidity. If somebody wants to dump $1 billion stake in private markets and the buyer pays 95 cents, I have no problem with them marking that up to NAV.
Right. Yeah, I agree.
Lastly, private company buyout multiples versus the S&P. This is wild, Ben. So for large cap and middle market, large cap is considered $1 billion plus, middle market is 100 million to $1 billion. They're looking at median enterprise value to EBITDA of the trailing 12-month multiples. There's no discount. There's no discount. And part of the whole appeal of locking up your money was that if you are going to give up liquidity, the higher returns better come from a lower entry point in terms of valuation. That disappeared.
I can't remember what the podcast was, but there was an interview with Mitt Romney a number of years ago. And he was talking about how Bain Capital, when they bought companies, and he started out in like the 80s and 90s, and they were buying these companies like 2 to 4 times.
Yeah, they're shooting fish in a barrel.
And yeah, he's like, of course our returns were great. The the valuations were ridiculously low on these companies. That's not the case anymore.
So the small cap, so under $100 million, yes, there still is a substantial discount there. It's 8.8 times, as there should be, right? So anyway, JP Morgan Guide to Alternatives, very good resource. The Unlock, Talking Wealth with Phil Huber. All right, Ben, let's move on to the Sapphire Reserve. So
right. You threw it out there at the end of the show last week.
Yeah, I didn't have the time to go through it. Are you bailing?
So I may have changed my mind. I maybe overreacted last week. Credit to me for raising my hand and saying it. So you said, well, they're raising the fee to what, $7.95 a year, which just sounds insanely high. So this is from the Points guy. They broke it down what you get. So you get a $500 annual statement for their curated luxury hotel brands. You have to do it through them, which I hate using the portals on the credit cards to book travel. I don't like it.
This sucks. Split into two $250 biannual credits. That's
yeah.
annoying.
So that means you have to book twice. So that one you're probably not going to use. So you get the $300 annual statement credit. Here's for you for StubHub. Okay. Again, split it between 2 6-month periods. $300 in DoorDash promotions. So that's not bad.
Oh wow.
$300 in dining credit.
But wait, Ben. Yes, there's all of these things, but you really have to be on top of it. So for example,
yes, exactly.
For DoorDash, $300. So you do the math, you're like, they're paying you. No, they're not. For DoorDash, it's a $5 restaurant promo and 2 $10 promos on everyday essentials each month.
Right, and you have to activate it. You get a statement credit for Apple TV or music, so I would use that. That's fine. $120 for Peloton membership, $10 a month. So I'll use that. The DoorDash Dash Pass membership, which takes away some of the fees.
Dude, this is a job in and of itself.
But yeah, it's a lot. So you're right. You have to be on it, and that's why they know. Plus, they have the $300 travel credit applied to all purchases made in travel category. So you get that.
So listen, this is decent value.
But so it ends out working out for me. But they know people aren't going to use all these values.
Exactly.
That's why. But
but you're not canceling. You're not leaving.
I'm not leaving.
Okay.
I'm still here.
All right. I also grabbed this chart from the JP Morgan's Guide to Alternatives. I just wanted to flag this one thing. They show retail real estate per capita. Look at us. We are so far number one. We've got 23.5 square feet per person. Canada's number 2 at 16.8. Then Australia at 11.1. UK is 4.6. Japan is 4.4, China's 2.8.
So think about it. When you drive through America and you pass a town on the highway, every town in America you see, there's a Best Buy, there's a TJ Maxx, there's all these, there's all these retail, Target, whatever. You don't get that when you drive in other countries, right? You don't see all this big box retail. So you're right. That's what we have, and obviously we love to spend money.
Ben, I put the car stuff in the travel section, so I just wanted to pull out two quotes. Yep. We spoke about this earlier. How cars suck. Quote, this is David Francis Kelly. Credit to David Francis Kiley. I'm sorry. Great quote here. The gizmo that failed in my Ford Escape that pivots to direct either hot or cold air in the HVAC is plastic. The cost to replace was over $2,000 because the geniuses at Ford buried it with no access unless the whole dash was pulled out. By the way, we forgot to mention this, I think. Maybe I did, but I don't think we did. A couple of months ago, somebody emailed us and was like, hey, you guys are always talking about people like David Francis Kiley, like where do journalists get these people? There's a website that matches journalists to everyday people. Did you know that?
No.
Yeah. I forget what the site is, but there's a repository of people waiting to talk to journalists.
Probably people who leave Yelp reviews.
Here's another one. My 2013 BMW X5 rear-ended a small car and the damage to my car looked minor, said Tom Walken, a psychologist in Raleigh, North Carolina. But the electronics in the front bumper area pushed the repair cost to more than 75% of the car's value. So North Carolina law required that it be totaled. Yeah, this sucks. Cars suck.
And his insurance probably went up a lot too.
All right, Ben. Continuing another mega trend of remaking movies from our era. A new Harold and Kumar movie is officially in the works. I like Harold and Kumar when I was younger. I'm probably not going to see this.
These movies didn't do it for me. I probably watched the first
because you weren't a stoner.
Yeah, but I loved Half Baked though.
Okay. Well, who didn't?
So this one, it just didn't do it for me.
You know what I saw last night? So during the finals, when Halliburton's Achilles exploded, which was disgusting, and that sucked. Feel bad for him and Pacers fans. During halftime, I said, you know what? I'm going to the movies. I will watch the rest of the game on my phone if I need to, but I'm not anticipating a nail biter.
That's a pretty good choice.
So I went to see, because I'm not going to be able to see it for a while. I've got stuff coming up. I went to see 28 Years Later. Awesome movie.
See, I kind of want to watch the first two before I watch that one again, because it's been a while.
So 28 Days Later, I rewatched.
That movie was like a phenomenon when it came out.
It was. I never saw 28 Weeks Later, and I was told to skip it, so I did.
Oh, I like that one.
Okay, 28 Years Later was a certified banger. It was awesome.
Okay.
Awesome. But anyhow.
See, that's one of the ones where you and I are actually on the same wavelength here for kind of a horror-ish movie.
I'm surprised that you like that sort of stuff. But
I like
okay. Anyway.
When the guy's walking through the hospital in the first one and being like, what? And it's the guy, it's
Cillian Murphy.
Oppenheimer, yeah.
There was a trailer for, I thought it was a full reboot. It's not a reboot. I Know What You Did Last Summer, because Jennifer Love Hewitt and Freddie Prinze are in it. I'm in for that. Even though that was
so one of the two of them is going to be the killer. Spoiler alert.
That was like
right?
a C-level teen horror movie in my opinion. But I'm going to see that.
Definitely saw it in the theater. But let's be honest, one of those two is the killer now.
No way.
Yes, that I've not seen it. I saw the trailer. One of them is the killer.
Stop.
Trust me.
Yeah. No. Okay. What else is going on, Ben?
All right. Before recommendations, we'll keep it short for Duncan this week since we went so long last week. This is just another old person, middle-aged thing. My wife and I, with some friends, went to a new restaurant this week, just kind of in the middle of nowhere in northern Michigan. It was on a golf course, and there's like a farm in the background. It's called the Farmhouse. And this place was spectacular. It looked awesome. The vibes were great. The food was absolutely amazing. If I would have gone to a place like that when I was young, I'd be like, oh, this place is pretty cool, and never think of it again. My wife and I were talking about this restaurant for like the next 24 hours. Like, I can't believe how awesome. It felt like a New York kind of restaurant. And that's the kind of thing when you're older that you get excited about. Totally. Finding a new restaurant.
Oh, yeah.
Right? When you're young, I don't care. I didn't remember what the name of that place was. I don't remember what I had to eat last week. When you're older, you find a new restaurant, it's like you tell everyone about it.
Yeah, it's a big topic of conversation amongst 40-years-olds.
Right? Did you guys try the new place down the street yet? Amazing.
No, I'm dying to.
Yes. Oh, we're definitely going to go next time. All right, I got some recommendations. Okay, you got nothing in here this week, but
no, I just recommended 28 Years Later.
Okay, I got two this week. We watched The Accountant 2 on Amazon Prime, and I don't know if this went to the theaters or not, or if it was straight Amazon Prime. Okay. Did you watch Accountant 1, the first one?
I didn't love it.
See, I liked it. I honestly, my wife and I were talking before we watched this. I don't remember what, I remember.
It's very forgettable. I saw it recently. Again, it's very forgettable.
I kind of liked it. The second one, I feel like had no connection to the first one at all, like a little bit, minorly. But then John Bernthal is the brother, who I think he was in the first one a little bit. Again, I don't remember it.
He was a little bit.
It's a totally unnecessary movie. Didn't need to be made. Completely unnecessary. And I was totally entertained. Great. Like, there was some great scenes with Affleck and Bernthal. And Bernthal is probably the best character actor there is right now.
Bernthal's the best.
He is so he has so many good lines in this. And again, a totally forgettable, like, unnecessary movie that was completely entertaining, and I totally enjoyed myself.
Did you see We Own This City? Did you see that on HBO? The Bernthal miniseries?
Oh yeah. That was pretty good.
He's awesome.
He's the cop.
He's great.
Yeah, he's the Baltimore cop. All right. And so the new Owen Wilson show on Apple called Stick. Have you seen this yet?
I saw 2 episodes. I don't love it.
Okay. My wife and I plowed through 5 episodes this week. It's a little bit of a coming age, so but it's one of these shows where, like, you don't have to invest a lot of yourself in it.
Okay.
It's just light and breezy and entertaining. Okay. And you know what always works? So in the 5th episode, they did a montage. Put a song. You can see people talking. You can't hear what they're saying.
A montage is it's like the fast forward button.
Yeah, we're going to this town. We're going to this town. So it's a road trip show. It's golf. It's got a little bit of heart on it because there's people dealing with grief in the show. But it's not the kind of show you have to be totally invested in. It's just very light. And I was thinking, Owen Wilson just always plays himself. He literally is the same character in this show that he is in Wedding Crashers, and he looks exactly the same. He's got literally the same haircut still as he always had.
He's the best.
But he's the best. He plays himself, but it seems like he's playing, I don't know. My wife and I both really liked it. Mark Maron plays the sidekick. I really am into it. We've plowed through that one very quickly.
Okay. I have another quasi-rec. It's not a rec, it's just a movie that I saw that I liked, but it's I feel like it was fun but underwhelming. And it was just a little, vibes were weird. You ever see Plane with Gerard Butler?
Okay, it's funny because I was having this conversation last night with my wife.
It felt like hollow. Like I should have loved that movie.
But do you ever go on Netflix or one of your streamers and you see they have the continue watching thing and it shows you the movies or shows you're watching?
Yeah.
And you see something that your spouse is watching and you go, "What the fuck? What are you watching that?" And she was watching Plane.
That's bizarre.
And I wanted to be like, what are you watching this piece of garbage for? You watching it, I get.
Plane was a high quality piece of garbage.
Okay.
Yeah.
Right.
Total junk.
It's a Gerard Butler movie. Aren't all
I have a man
movies,
crush on Gerard Butler. I love him.
Aren't all of his movies high quality pieces of garbage? Let's be honest.
Yeah. Well,
no offense to him. He's carved out a nice lane.
300 was not garbage. So watch your mouth. Careful.
Okay.
Do not talk about Leonidas that way.
That movie's okay.
That's a great movie. All right. We went long again.
Not bad. As you hear this, we will be recording a live show at the Morningstar Conference on Navy Pier in Chicago, which should be out as like a bonus episode. And we're going to do something a little different for that, so that should be fun. Come say hi if you're there. Anything else?
Hey, stay cool in the heat.
Okay. I got nothing. I got no time for weather. Sorry.
Yeah, Ben hates weather talk.
It's true. But what else is there to talk about?
No, that was it. You just say, yeah, stay cool.
All right.
Go yourself, San Diego.
All right. Thanks to the production team. As always, email us, animalspirits@compoundnews.com. We'll see you next time.